What's up, everyone? Welcome to the daily macro update for Monday, December 15th. My name is Johnny Zerdy. We have a bunch of stuff to get into today, mainly with the New York Fed Manufacturing Index, which is one of the leading economic indicators for the manufacturing sector, as well as we have a couple Fed governors who gave speeches today. One being, I believe it was John Williams, and the other one being, let me see here. Stephen Miran. So a couple of Fed speeches, kind of just reiterating a little bit of what we saw last week, but it's still good to hear them, talk to see if there's any type of, differences from the Fed meeting from what Jerome Powell said. So we'll go over that, as well as we'll go over some key developments that we're seeing here this for today this week. And so if you guys haven't already, we did a Sunday macro wrap up last night. We went ahead and went into a lot of the emerging trends, as well as the strongest trends, the worst trends, as well as kind of this whole macro setup heading into 2026. I would highly recommend you check that out. Also, as well, we still have 2 weeks left of our 6-week macro mastery challenge, where you get free access to our partnership circle community for 6 weeks. And you essentially get access to our entire list of tickers, alerts that we're putting out every single day, as well as all of our specific reports for the macro environment, things that we're looking at, things that are on our radar to buy soon that may be having an uptrend here, emerging opportunities as well. And then it includes all of our educational videos, as well as all of our tools. So you gain access to things like the trading ranges on TradingView, and so you get a user license for that. And if you guys are interested in that, go ahead and take a look at the description below. There's a link that's in there. You can book a time with me, or for those that are joining on TikTok or Instagram, you can hit the link in the description and we can hop on a call there. But let's go ahead and get right into it here. So taking a look at this headline here, I hate when they use these words like unexpectedly shrinks, or, surprisingly fell, or surprisingly boomed or soared. A lot of this emotional language is just for people to click on the actual article. So it's always important to just take a look at the actual numbers here. And so, even with that dramatic title, let me go ahead and zoom out just so that you guys can see this a little bit better. Let's go back on the 3-year. So as you can see, when taking a look at the New York Fed Manufacturing Index, you can see that, yes, it did have, a little bit of a negative print for December, but it's getting less negative, right? We're actually seeing some positive territory here. And so this is actually a positive rate of change, right? It's the rate at which these numbers and indexes are changing, not so much the monthly nominal number, because, it can be slightly negative here, and they put this dramatic title, unexpectedly shrinks, but really, it's more positive on a rate of change basis, which is really what we care about, right? And so in taking a look at the other components, this was mainly led to a fall off in new orders after the large increase in November. This is mainly due to the holidays, but new orders are pretty much just continuing to go back and forth there. The most important thing is that prices are starting to come down for the manufacturing sector in New York. And so as you can see, this peaked on May of this year at 59 points. That was really one of the highest prints that it's had ever since the 2022 inflation surge. I think the last time it was higher than that was July of 2022. So as you can see, this was the inflation that we had in 22, and then it came back down, got down to a low of around 16, which was in December of 2023, and then had a little bit of a reacceleration here, and now it's coming back down to that lower level here. And so this is actually good news in terms of the input price dynamic with the manufacturing sector. And so this is why, people like Jerome Powell, as well as people at the Fed, are saying, hey, this might be a one-off inflation acceleration from tariffs, and we could be going back to a more normal level in terms of inflation in 2026. And then when taking a look at the employment index for the New York Fed Manufacturing Survey, we can see that this is having a third month of acceleration. So that's pretty good as well for the labor side of things, right? So yeah, not too bad as far as a manufacturing index print goes, actually. So ignore the headlines there. Also, as well, we had a couple of Fed governors do a meeting each today, or not necessarily a meeting. It was more like a speech or a Q&A. And so the first was Fed Governor Stephen Miran, which he's a little bit more of a major dove, right? He was the most recent one that was appointed by Trump. And so, his whole thing was that the main reason why inflation went up is because of these tariffs, and as they come down, the main thing to be looking for is shelter inflation, right? So we get CPI on Thursday. If we take a look at the schedule for this week, as you can see, CPI for November is on Thursday at 8:30 a.m. Eastern time. And so that's going to be the main component that we're going to be paying attention to, as well as tomorrow's non-farm payrolls. Those are really the big two this week. But when we take a look at the CPI number, what we really want to be paying attention to is this shelter component here, right? And so as you can see at the timing of this video here, the shelter component of inflation is 3.6% year over year. And so, really the pandemic norm was hovering around kind of 3.6, but also, around 3.2. It's right around that like 3.3 area is what the market is typically used to. So we're pretty close to it actually, right? And so whenever the Fed kept saying we're making progress on inflation, he's talking about the shelter component right here, which it is true. Shelter inflation has been coming down, but this is again the rate of acceleration, not cumulative inflation, right? Because when we take a look at cumulative inflation, which is the index level, a lot of people forget that like the CPI, Consumer Price Index, it's an index. It's not just the percent change, but that's what they've thrown in everyone's faces, because if they were to show cumulative inflation, then people would be having a huge problem. But as you can see here, since 2020, this was at 325, and now it's at 418, right? So what's the math on that? Let's see. Yeah, so that's about a 28% acceleration cumulatively from the pandemic. They don't show you that that's the real number, right? They don't show you that cumulative inflation since the pandemic is up 28% for the shelter. What they do want to show you is the annual rate of change, because that's a better number that they like to feel good about, right? So the Fed can go on TV and talk to us all about inflation, but really the prices that you and I experience every day is this cumulative inflation number. It's not just the rate of change. The whole rate of change thing is what they like to look at. Now, as traders and investors, we look at it too in terms of other things that have a positive or negative reaction to the rate of change of inflation. That's something that's different. But these people at the Fed, they're absolutely insane. And it's something where it's 100 years of just deceiving the public. And the Fed is just essentially taking away our purchasing power so that they can enrich themselves. So that's really the way that it goes. The bankers and the financiers are making us hidden slaves. But all right, I want to focus on. But when taking a look at some of these governor speeches, Stephen Miran, he was really saying that they need to cut more because the labor market is at severe risk, right? His whole thing was that I'm waving the red flag because the unemployment rate is going to, skyrocket, and we have rates way too high. We're fighting the inflation war from 2022. We're way behind. We should be cutting like crazy right now. Whereas John Williams, on the other hand, was like, he's a little bit more of a moderate, right? But he was saying that we need to just continue this gradual approach where we cut some, then we pause for a little bit, and then maybe we'll cut some more. And we just need to keep an eye on things and be more dynamic. So, both were saying, though, in their speeches that inflation has, you know, made a lot of progress and that they're not necessarily too much worried about long term inflation being above their target. And so, we'll see what happens. In terms of this inflation report that's supposed to come out on Thursday, the Cleveland Fed nowcast for inflation is showing that this is going to be coming at 3.0%, 2.99 if you have two decimal places, but it'll show as a three handle. And I think that a lot of people will look at that and be like, see, I told you, inflation's staying at 3%. The Fed is crazy. I agree that they're crazy. But again, looking at the November number, you're almost 2 months behind at this point, looking at that. You have to be paying attention to more forward-looking indicators, such as the rate of change of oil, as well as the rate of change of the 5-year break-evens. And those are suggesting that inflation will start to come down a little bit. But with that, though, there's a lot of things that are not liking that right now, specifically some of the big mega cap stocks that have benefited actually from the rising interest rates because they've had so much cash on their balance sheets. They've actually benefited from rising rates. And it's kind of weird. This is like the first time in history where raising interest rates actually benefited a select few amount of companies. And then also, too, other types of inflation indicators that do well when inflation is rising, like Bitcoin, that had a pretty large decline today. If we take a look at Bitcoin here, if my chart will want to load, let's go down to Bitcoin. More of a haircut here. We'll see what we're getting a decent bit of a price acceleration or a price deceleration on accelerating volume, that is, and getting close to the low end of the trading range. But our communication over the past, I don't even know by now, really since mid-October, that Bitcoin has been bearish in our model, and it remains bearish. So there's not really any reason to try and pick bottoms here. A lot of people who thought it was a bottom, who were chasing, around 94K, they're eating the bones again. So another long squeeze that just happened. And ultimately, though, in a macro sense, Bitcoin is something that is very not only inflation sensitive, but liquidity sensitive, both of which are still, in restrictive territory. Now, a lot of people will say, hey, I heard that on the Fed meeting last Wednesday that they're going to be buying $40 billion in treasury securities every single month. How can you say that they're not doing quantitative easing and, flooding the market? Well, the reason why is that they are front loading all of that into treasuries or treasury bills, rather. So this has to do with keeping the government afloat with their short-term thinking, with, funding the government deficit with treasury bills. And typically when they do classic QE, which really is something that's new since 2008, but when we say classic QE, that's when people think about, the Fed flooding the market with liquidity. That's not actually happening right now. This is where the bathtub water was incredibly high after the pandemic, after they flooded the market with $4 trillion. And since 2020, it's come down to a more ample level of bank reserves. And so they're just trying to hold it there. And so they're just turning on the faucet a little bit so that, that it holds at that level, right? Because ever since 2023, when it was flooding, when there was a lot of liquidity in the system, they were adding money from the reverse repo facility, as well as they were doing quantitative tightening. And so those were kind of balancing each other out. You were having the stimulus of the drain of the reverse repo facility, while the reverse stimulus of QT. Now that RRP is out of the picture, now QT is out of the picture. Look at that. And so in order to accommodate this stagnant level of reserves, now the Fed is coming in and essentially being the new RRP, right? So this is where the new liquidity is coming from, and it's not to flood the market with liquidity again. This is more about keeping things relatively stable, right? And you don't just have to take my word for it. Even John Williams in his speech today said this, right? So he clarified that the Fed's recent move in bond purchases, right? So ending QT, this was a technical tool to ensure that the interest rate control, to ensure interest rate control and market function, right? So this is, he said it himself, this is not a form of economic stimulus. This is a form of uh, bank reserve preservation. All right. And a lot of people need to understand that, because if you don't understand that, then you're just going to get fed all these BS narratives on YouTube and on Twitter, and you're just going to ape into all these different cryptocurrencies and Nvidia, and you're going to get caught off guard. In fact, Nvidia just went bearish on our model the other day. So that's something where you want to not want to chase, right? So, yeah, that's pretty much what I'm seeing here. When it comes to the target rate probabilities, we had an increase in probabilities yesterday to more of a pause in the January meeting. And so we talked about this a little bit last night, but the odds of a pause continue higher. And that's what it's looking like it's going to be. When we take a look at the current trajectory of rate cuts for next year, there's just two that are being priced in, one in April and then the other one in September. I guess they moved it up to August now. Okay, one in April and one in July. Okay, so they moved it to the July one. Okay. And then they have the neutral rate around 3%, or in between 3 and 3.25. And again, that's a lot higher than 0% from what we experienced from 2008 to 2020, as well as that's a lot higher than Trump's 1% goal that he wants. And so let's say even if they cut rates twice next year and they get down to that neutral rate that they have in their minds, is that going to take care of the rollover risk that the government is facing right now with the trillions of dollars that it's printing, right? The stimulus has not been coming from the Fed. All the stimulus has been coming from the government. And a lot of the excess dollars that were in the system from the pandemic stimulus over the past 3 years that were in the RRP, that was being used to purchase bills. And so that extra stimulus went right into the market as an injection. So a lot of people who are saying, when's QE coming back? It's been happening. It's been happening as shadow QE this entire time. So this is actually the first time where we've gone into a more restrictive type of environment, right? Because you're no longer getting those new dollars coming in. So yeah, and that's part of the reason why Bitcoin is not liking this new environment. So what is working though is things like small caps, which did provide a little bit of a dip here. Not quite at the low of the trading range, but this is something that's definitely on the list. And with the title of this video, with silver being the best trend right now, you can't stop the silver train. So taking a look at SLV, silver, precious metals, platinum, palladium, all of them are the strongest trends right now. So that's what will continue to work. And, it's still up a lot. It keeps on closing at the top end of the trading range. So really the biggest buying opportunity that we had was on November, end of November there, the third week of November, as well as, you had a brief opportunity that first week of December, Tuesday the 2nd. So not too many opportunities there. I guess you did have an opportunity on Monday or on Friday to buy a little bit, but yeah, it's pretty telling when you have precious metals doing this, Same thing with copper and copper miners. Silver miners. Silver is still outpacing gold by a lot. So if you're trying to choose between one or the other to buy dips on, silver would be the winner there. Um, yeah, so that was the main thing. In terms of like risk right now, volatility still remains below 17, which is, this is great dip buying opportunities for things that are in bullish trend. Credit markets are still remaining relatively stable. Um, Bond yields on the long end are doing what they're doing because the Fed essentially put a choke collar on the short end. So yeah, pretty interesting stuff that's going on. Yeah, my team and I, we were selling some of our healthcare since that had a pretty decent jump, but we'll see what happens from here. If it's able to continue higher on accelerating volume, then we'll see what happens there. But, we did see more of a decelerating volume type of environment here. So we'll see what happens. Still lots of bullish opportunities, though. I was buying a little bit of energy today on this dip. For those who are subscribed to our to our macro investing community, you may have seen this morning, but yeah, there's still a lot of bullish trends that are out there. Expand your horizons when it comes to options, available options of buying things, right? Don't just think the only thing that you can buy is AI stocks and crypto. There's other things. All right. Is there any correlation with the manufacturing/service index to the Fed rate cuts? I mean, there is a little bit. They do pay attention to the manufacturing data, right? So, um, manufacturing, you have to understand, it's not the bulk of the United States GDP, right? The United States isn't necessarily a manufacturing type of country, although we do manufacture some things. Really it's more of a leading indicator into the services industry because if manufacturing takes a crap, then it typically, it's typically an early indicator that leads the service sector, which is really the big thing that is the main driver for the US economy. We are a service-based economy, so that's the main reason why they pay attention to these manufacturing numbers. But what was interesting is that, excuse me, over the past few years, in 2023 and 2024, when we had abysmal manufacturing numbers, that it never really translated into the services economy, right? So if we take a look at the New York Fed Manufacturing Index, let's go back 5 years or 10 years here. So as you can see, let's just do post-pandemic. As you can see, right, so this was 2021, 2022, 2023, and 2024, all for the most part were, very deep negative numbers, right? And so what the fear was that, is this going to translate into the services sector, which it did a little bit, right? We did see a little bit of a contraction earlier this year in the services economy, but it's had a little bit of a rebound since then. And so, yeah, with this actually having a bit of a recovery right now, that's actually, quite optimistic. So, but yeah, I mean, it's mainly just an early indicator for services. But I'm sure the Fed looks at it. I'm not sure if they act on it since it is private data, and um, they mostly look at the government data. So yeah, because at the last meeting they pretty much just ignored all the private data. I think you were right about MicroStrategy. I did seller 80% of MicroStrategy. I had 35. I kept 10. Um, .dev.x. How do you mean by that with MicroStrategy? I'm not sure what you mean. Oh yeah. Yeah, I mean, I think you were asking me last week or something like, "Hey, does MicroStrategy look like it's bottomed?" And I was like, "No." It's still a completely bearish trend, and just because it's down 35%, doesn't mean it could drop more. Right, exactly. Now, I don't know how much it could drop more, but if something's in bearish trend, I'm not buying it because of that risk. I will let something become bullish trend and then buy it on the next dip, right? Because my probabilities of success are a lot higher if something has already bottomed and is showing that it's having a reversal, right? And then you just buy on the next opportunity. I'm not in the business of trying to buy and time bottoms and gamble. That's not what our strategy here is at Macro Optics. It's all about waiting for confirming trends, seeing how that aligns with all of the other assets that we look at: currencies, the bond market, equities, precious metals, commodities, all those different things. How are the correlations looking? And then let's take a look at the leading macroeconomic data from all that, as well as compare it to the lagging real economic data that gets produced by the government, as well as some of these private, surveys. What is all of it saying? And so if we have something that is reversing in trend, that has already bottomed, that is, typically in an industry or a sector that does well, given the current developments with the macro economy as well, that is a winner right there. That's exactly what we saw, for example, back in 2023 with gold, right? And gold has been on a tear for the past couple of years, and gold has outpaced the S&P 500 by multiples over the last few years. You don't really hear that on mainstream media news, but gold has really been the best performer, and now silver is catching up too, right? So, yeah, I'd rather wait for a higher probability opportunity and then go a little bit heavier on that than just trying to, go to the roulette table and sprinkle, 15 or $20 on every single space that's there, right? Hopefully that makes sense. Are there any instances where you buy in bullish trend but not at the loan of the trading range? Sometimes, yeah. If something is in a very strong bullish trend and volatility is just, completely dropping off, and maybe you get like a tiny little standard deviation move downward, and maybe it just goes down to the middle of the range, then yeah, you can buy that. You don't necessarily have to exactly buy every single time at the low end of the trading range. Um, really, the low end of the trading range even more so acts as a point where if it closes below that on accelerating volume, then that's typically a high percent chance of a trend shift within that particular asset. But I mean, sometimes if we get it down to the low of the trading range on lower volume, then great, that's fantastic. But no, you don't have to. If something is having a dip, you absolutely do not have to just wait for the low of the trading range. You can buy it even before. But good question. All right, let's see here. Thoughts on NVIDIA? We went over it earlier in the show, but NVIDIA is currently bearish trend in our model. And yeah, I mean, doesn't look great. So when something's bearish trend, not even touching it. Yeah. So let these charts come to you. There's no stress. Let these charts prove to you that they're worthy of being in your portfolio. Don't chase them, right? All right, let's take a look at some of the comments here on TikTok and then we can go ahead and wrap it up. Let me just scroll down here. Yeah, semiconductors. If you take a look at the chart SMH, it's it's still in that camp. SMH does have better strength, right? It almost looks like a chart of small caps, but yeah, it's had a pretty decent couple days of down days. So I mean, yeah, not something particularly that's on my list. Thoughts on the Bank of Japan rate hikes this week? Was that today or is it tomorrow? I think the market has already priced in the rate hike for Japan, so I don't think it's necessarily going to be a huge thing. It all has to do with what's already priced in. Yeah. All right. Well, good questions there. We'll go ahead and wrap it up there. I appreciate everyone for joining. Also, just as a reminder, we still have our 6 week macro mastery challenge, which I mentioned at the beginning of this video. But if you want to, incorporate this macroeconomic strategy for yourself, and you want access to all of our tools, just book a time with me on my calendar here, and we can review everything to see if it's a good fit. But I appreciate everyone for joining. Have a great rest of your Monday, and we will catch you in tomorrow's daily macro update. Bye, everyone.